This is Chapter 20, Budgetary Planning. A budget is a formal written statement of what management plans to do in the future time period. If we're going to do a budget for 2013, most managers would start now planning for next year, starting January. This is a primary way to communicate upon the objectives of the company and promotes efficiency among managers. They make sure we're not duplicating any efforts. This acts also as a control advice, as we talk about in the next chapter, which is budgetary control. Historical accounting data on revenue, costs, and expenses are there. They've been collected, they're actual data. And what the managers then use is the past data, and they develop plans for the future. And these are plans that are done in financial terms. The benefits of budgeting: everybody's involved. Everybody knows what the goal of the organizations are, what the objectives are, and they are going to plan ahead. And if there are any problems, then we know in advance, because the budget will be an early warning system. And other benefits: it makes managers work together, coordinate their activities. It makes you aware as a manager as what's going on in other areas of the company. And it provides a reason to motivate you. You say that you're going to plan this next year, then because you stated that, you as a manager are going to be motivated to achieve that result. So those are many of the benefits of budgeting, but there's one thing you must remember: that a budget is an aid. It helps you manage. It is not a substitute for management. You know, if you have a bad manager, when they say, okay, well, that's not in the budget, that idea is no good because it's not in the budget. They're using the budget just to say no to any new idea. They're not using the budget as it's designed to help managers manage. Basic benefits here: good organizational structure, everything. All managers are working together. Now, when we talk about a budget, we're talking about a one-year time period. That is the time frame for the complete budget. But we break that budget down into monthly, even weekly in some quarters, or quarterly budgets. But they're all just a portion of the one-year budget. Okay. Now, the way you develop the budget process: you look at what you've done in the past performance, you collect data, you look at the sales forecast, what's going to happen in the future, what it would be our expected market share, and so on. So the budgeting process then all starts with the sales forecast. That is what we're in business for. We make sales to our customers. So we have to forecast in the coming year how much we're going to do in the way of sales each month. And we look at the general economic conditions. We look at our competitors. We look at market research studies. A lot of what you take in marketing helps you determine what the sales forecast would be. Now, some companies, it's all informal. It's just, if it's a smaller company, it's managers working with managers. But in larger companies, you may have what's called a budget committee, where it's a group of people from the president, controller, treasurer, and so on, are all involved in working with each management for the major area of the company. Now, there are two ways of doing this. There's called the top-down way, where the budget is set by the president, and everybody has to go and develop their budget according to what sales forecasts the president has decided. Or there's a bottom-up approach, where we start with the sales department and we build up from the bottom up to the top as to what our forecast will be. And then we tell the president, this is what we think will happen. That is called participative budgeting. The advantages is that you're using lower level managers. They become part of it. They perceive the process as being fair. They're all going to be motivated to achieve the overall goal of the corporation. And that's much better than top down, much more reliable budget figures than top down. If a manager at the lower level said this is what activity he expects he's going to do next year, he basically owns that forecast, so he's motivated to get it. But if the president top down said, okay, this is what you have to do next year, that manager is not really motivated because he's just been told that's what he has to do. So that's the advantage of participating budget, or what we call bottom-up budgeting process. Disadvantage of participative budgeting is time, and it's very involved, and people tend to build in numbers, which they call slack. If they think they're going to do 10,000, they'll say 9,000. So they built in 1,000 slack, and they intentionally underestimate their revenues or overestimate their expenses so that they will come in under budget. So that's part of the problems with bottom-up participative budgeting techniques. But here you have it. So you have departmental managers at the bottom, department managers here and here. Okay. Then you have plant managers at this level, production and president. So they're all building their budget up to the top. The budgeting time period is 1 year. That's what we call an operations budget. If we go, there's also what's called a capital budget, which is longer than 1 year. But this chapter, we're focusing only on operating budgets. We set specific short-term goals for those budgets, okay? Now, all these budgets together are called the master budget. Now, the master budget is two parts. There's the operating, that is the sales and the production and the marketing and those types of budgets. These are individual budgets that are prepared. They're basically building an income statement. At the top, the sales, then the cost of goods sold, then the general admin expenses, and so on. Aside from that, there are what are called capital budgets. Capital budgets are long-term budgets. Now, that's not the subject of this chapter. That's the subject of part of your finance course. But there's the cash budget. That's very much a subject of this chapter. And we'll talk more about the cash budget later. That's one of the most important budgets. So here you have the master budget components. You start off with the sales budget. They tell you what they think they're going to sell for the year. Then the production manager produces enough to meet the sales budget. Then the production manager also determines, or the purchasing manager then must get enough material to meet the production budget. The production manager must make sure he has enough direct labor, and then they do the manufacturing overhead budget. Those are the different areas in the manufacturing plant. Then there's the selling and admin budget and an expense budget. And when you take all that together, what you have is a budgeted income statement. Now, the financial budgets are down here. The capital budget is long-term. That's 5 years. We're not interested in this chapter on that. What we are interested in is the cash budget. We must make sure we have enough cash to pay the bills throughout the year as those bills come due. So the whole thing starts with the sales budget. This is the first. They give us the best estimate of sales revenue. And they break it down, expected unit sales for each product and the selling price for each. So this budget is rather straightforward. Here we have quarter 1, 2, 3, 4. Expected units of sales, 3,000, 3,500, 4,000, 4,500. Unit selling price, the selling price per unit is going to remain the same all year long at $60. So therefore, sales the first quarter, 180,000, second quarter, 210, third quarter, 240, 270. Okay, now from there, the production budget. Now the production manager has to produce to meet the anticipated sales. But there's something in addition here. Not only does the production manager have to produce to meet the anticipated sales each quarter, but there will be a policy that management has put in place. And that management would say that they want ending finished goods to be a certain percentage of next quarter's sales. So now the manager must, to determine how much he produces each quarter, he looks at how much will be sold during the quarter, plus how much does he have to end up at the end of this quarter in ending finished goods. But he starts off the quarter with beginning finished goods. So it's budgeted sales plus desired ending inventory minus beginning finished goods. And that gives him the determination of what he has to produce. Now, an example. Here we have Hayes Company. Management believes it can meet future sales within an ending inventory. They want ending inventory 20% of next quarter sales. So here's the sales: 3,000 first quarter, 3,500 second quarter. Now, I need to end up the first quarter with 20% of what I need for sales in the second quarter. So 20% of 3,500 is 700. So I need 3,700. But because it's management's policy that was consistent last year, at the end of last year here, we ended up with 20%. We had to end up with 20% of what we needed for the first quarter, and that would be 600. So therefore, sales plus ending inventory minus beginning inventory, I need to produce 3,100 in the first quarter. Now in the second quarter, there's my sales, what I'm going to need, and I must end up with 20% of next quarter's. So 20% of 4,000 is 800. So in total, I need 4,300. But I already have the ending inventory last quarter is the beginning inventory this quarter. And so therefore, I only have to produce 3,600. And you follow that all the way through. Now, here you need to know what the sales are going to be the first quarter of the next year. And they tell you expected sales first quarter next year is 5,000 units. So 20% of 5,000 is 1,000. That's how they get the 1,000. So that's the production budget. The direct material budget is very similar. Now we have to determine how much we have to purchase to meet the production budget. This shows we have to figure out first the quantity, and then we multiply it by the cost. Again, management has a policy that with regards to raw material or direct material budget, you must have the desired ending inventory. In this case, it would be stipulated as 20%. So you do the same thing again. Direct materials used required for production plus desired ending inventory at the end of each quarter minus the beginning inventory at the beginning of this quarter gives us what we have to purchase. An example will give you a better idea. Management says you need 10% of next quarter's production, and the manufacturing of each unit requires 2 pounds of raw material at $4 per pound. Now, word of advice, don't deal with the dollars until you figure out exactly how much you need in pounds first. Deal in pounds, and on the last line, just multiply it by $4 per pound. Let's go. Here we have units to be produced. Now, this came from the production budget, the one we did before. Remember, we needed 3,100. Okay, that's what the production manager says he's going to produce in quarter one. We need 2 pounds per unit. Therefore, we need 6,200. Now, the second quarter, the production manager said he was going to do 3,600. We need 2 pounds, so we need 72. So go back to the first quarter. So this is what we need to meet production. Plus, we need 10% of next month's requirements. So in total, we need 6,920. But we already have 10% last year of what our estimated requirements would be this year. So we subtract the 620, and the total amount we need to purchase in the first quarter is 6,300 units. Then you multiply by the dollars, and you get 25,200. Again, second quarter, we're going to need 7,200 purchase, but we have. Now, that's what we need for production. We also need 10% of third quarter. There's our total needs, but we already have 720. So therefore, we need 7,300, and it costs $4 per unit. So that's how we build the direct material budget. The direct labor budget is straightforward. All we have to do is figure out the production manager tells us the units to be produced. We figure out we're told the time to produce one unit and the cost, and we get the total labor cost. So the production manager is going to produce 3,100 in the first quarter. It's going to take 2 hours to produce each one, so it's going to take 6,200 hours, and the cost is $10 per hour. So the total cost for direct labor is $62,000, and so on. We just use the production budget. We don't inventory labor, so we don't have to worry about it. The overhead budgets, now we have to deal with fixed and variable costs. Now the fixed are going to remain the same within a certain relevant range. We have to look at the variable costs per direct labor hour. And so we get those variable costs, and then we go back and we said, okay, the direct labor hours, we're 6,200 in the first quarter. Indirect material is $1 per direct labor hour, so it's 6,200. Indirect labor is $1.40 per direct labor hour, and this direct labor hour, of course, comes from the direct labor budget. And in this way, we build the variable costs, and the fixed costs are going to remain fixed over that range of activity each quarter. And in that way, we have built the manufacturing budget. The selling and mid budgets, they're basically done sales commission, freight out. They estimate the amount of sales and the amount of advertising, sales salaries, and so on. We come up with a budgeted income statement. I can get into further details on that, but we just take the sales budget, which we develop, the cost of goods sold budget, gross profit, and so on. So if we meet all our budgets, we will expect to make a net profit of $47,900. So that's how we build the operating budgets. Now, the very important budget is the cash budget. And here we look at the expected or anticipated cash flows. All right? We look at the cash coming in, which we say cash receipts, and the cash going out, which we refer to as cash disbursements. And we show beginning and ending cash balances. So basic format for a cash budget is beginning cash budget, add to it the cash receipts, and we're going to itemize them, and deduct from them the cash disbursements, which we will also itemize, and we look at the excess of cash receipts over cash disbursements. And we determine if we need financing, because we need to have the cash, and therefore there would be management's policy with regards to what minimum cash balance would have to be. The cash receipts section includes principal sources of revenue, that is cash sales and collection of credit sales. The disbursement includes all cash payments, direct materials, labor, taxes, dividends, whatever. Basically your expenses, but not depreciation, because depreciation is a non-cash expense. And then the financing section looks at how much I have to borrow or repay. So the financial budget, we start off, we say, okay, we have assumptions here. Cash balance at the beginning of the year is $38,000. We collect 60% in the quarter sold. Whenever we make sales, we collect 60% in that quarter, 40% in the next quarter. Collect $60,000 in accounts receivable at the end of December 2006. So we have $60,000 accounts receivable. Short-term sale investments, we have $2,000 coming in. We're going to pay direct material costs 50% in the quarter purchase, 50% in the next quarter. And right now we owe $10,600. We pay the direct labor when they work, so it's all in the quarter incurred. Same with the manufacturing overhead and so on. Now the scheduled accounts receivable. We start off, we're $60,000. First quarter, we're going to collect, what was it, 50% of it? But we're going to have to do a better job than that. Okay, there's your cash payments on your first quarter. Now, here's your cash budget. We start off with $38,000. We add collection from accounts receivable, sales and securities, that's cash in, total cash in. So the total cash coming in, and we already have $38,000, we have $208,000 cash available during the quarter. Cash disbursements, direct material, direct labor, manufacturing overhead, selling and admin expenses, purchase of a truck we don't have it this quarter, income tax expense. So we have 182 going out. So the difference between what we have coming in and what we have going out is $25,500. So we start off the next quarter with $25,500. In comes $223,500, out goes $211,000. So we end up with $12,000. But management's policy states that we must have $15,000 as a minimum balance. So therefore, we have to borrow $3,000 from the bank because to bring it from 12,000 up to 15. We start the next quarter off at 15,000. Income's 243, out goes 220. We have 22.5. That's more than enough. That's more than 15,000. So we pay back the 3,000 plus the interest, and we have 19,480, 400. Sorry. Start off the fourth quarter, and so on. And that's the cash budget. That's what you have to understand. Those are problems we're going to do in cash budget. We're not going to do anything with the budgeted balance sheet or any of the following things. Now, budgeting is just as important. We use the manufacturing company because it's more complex. But budgeting is a service company as well, and a nonprofit company. The university here budgets already for 2013. It starts in September. They're anticipating how many students they would have, what faculty they need, what support staff they need, and all that. So nonprofit organizations and profit organizer service companies like the university are also doing it. Basis of cash flow. So budgeting is a very powerful management tool, management accounting tool. Forces managers to plan.